don't underestimate the dynamics which are going to collapse the currencies. The only way in which fiat currencies can survive is if central banks decide to sacrifice financial markets to preserve the currencies. It's a choice either or. There isn't really a halfway in this one.
Please join us for our next live stream Sunday, October 9th at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be Sunday, October 9th, p.m. Eastern. See you then. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. Alasdair Macleod joins us today. Alasdair has been a celebrated stockbroker and member of the London Stock Exchange for over 4 decades. His experience encompasses equity and bond markets, fund management, corporate finance, and investment strategy. He is currently the head of research at Goldmoney, and he is a strong advocate for sound money. And we're delighted to have Alasdair join us once again today. It's time to saddle up and silver up for Alasdair Macleod. Alasdair, welcome back to SBTV. How are you doing?
I'm doing fine. It's my pleasure to be here.
Glad to have you back, Alasdair. Appreciate it. A lot going on in your neck of the woods, so I'll just start off with you letting us know what's going on with the British pound, the sterling skid of sorts, and of course, more recently, the gilt.
Well, how long have we got? I mean, we could talk about this all day. I think in a nutshell, the way I'm looking at it is that the new Chancellor, Quateng, is pursuing a sort of Hayekian course insofar as he wants to get away from the direction in which this government has been, if you like, the UK government has been going, which is just increasing state intervention, increasing state dominance over the economy, increasing taxation. I mean, continuing in that direction eventually gets to the point where the whole thing falls over. Of that, it's simple. I mean, if you look at the history, just the empirical evidence of increasing state control, at the end of the day, it stifles the economy and the system just completely fails. His budget is to try and get away from that. Now, this has come at a time when every other country is continuing its drift into greater and greater authoritarianism. What has happened is that by saying, no, we're not going in an authoritarian direction anymore, we are going to buck that trend, it has actually upset the global investment paradigm, if you like, the whole thing. It's upset it because the whole of the establishment, in establishment in investment terms, I would include investment fund managers, I would include investment strategists, the whole economics profession. I mean, they all have got used to declining interest rates, low interest rates forever as far as they're concerned. And they want to see central banks continue to suppress these nasty things like rising interest rates, like free market reality. Yet here we have a chancellor who's now bucking that trend. And what he is doing, actually, and I don't know whether he actually fully understands the implications of what he's doing, but I don't think it would change his mind, is he effectively is bringing on a global financial, banking and currency crisis. He's doing that because he's rather like the little boy who points out that the emperor is wearing no clothes. So that, I think, is the global significance of this budget. And it is why institutions like the IMF have turned round and said, oh, this is a terrible thing, da-da-da-da-da. Now, I think the critics do have a point in one respect, and one respect only. And that is that Quateng did not announce with the tax cuts, which incidentally were already, he'd already said he was going to do this. So, the markets were already prepared for it, in theory anyway. So it was a wake-up call when it actually happened, perhaps. But outfits like the IMF have turned around and said, you can't do this. It's irresponsible in terms of the government deficit and so on. They said other things which actually exposed their line of attack, which is, if you like, it promotes inequality. Now, that is politics. That's not economics. Now, come on. So we know where the IMF is coming from. But there is a valid criticism insofar as we didn't get, with this budget, any substantive plans to reduce the role of the state in the economy. That is the key thing. So what we see is a budget deficit ballooning, first of all, because the government is subsidizing energy prices to reduce the impact on households and businesses. And that is going to cost a lot of money. I mean, we're talking about 150 billion on some estimates, could be a bit more. We don't know. So on top of that, we have a reflationary budget, if you like, in Keynesian terms. So you can see that if there is a problem with this, it is in that respect. Now, he has promised to make a further announcement about spending cuts in a budget due to be presented in November. I think that some of the information will actually be brought forward. But I think the key thing in all this is that it's a huge upset for financial markets, which so far hadn't actually been paying attention to what's happening to interest rate trends, inflation trends. I mean, every central bank, including the Bank of England, by the way, still expects consumer price inflation to return to 2%. Hold on. We're already at 10% here, going on 13, 15. We even had Goldman Sachs suggesting, and I don't know what their revised figures will be, that it's going to be something like 22% in the new year. That's in this country. You've got the same thing everywhere else. So if you are stupid enough to be long of financial assets at this juncture, you are now waking up to the possibility that the central banks have actually got it all wrong. And that comfort blanket, if you like, of central banks ensuring that there are going to be no major losses on your portfolio, I'm sorry, doesn't exist anymore. I think that's the real significance in the whole thing. Now, there is a subset to this. I mean, the Bank of England quickly reversed its plans to quantitative tighten and has brought in instead, it was going to quantitative tighten due to start fairly shortly by the tune of about £80 billion. Now, instead, it is quantitative easing again to the tune of about 65 billion on indicated plans so far. Now, the reason it's had to do this is because of a crisis in the pension fund industry it's triggered really by rising interest rates, though the way the press have put it is it's because of rising gilt yields. Now, to understand that the problem that the pension funds have is that we all understand that pension funds just basically take in pension contributions and they invest them. And over time, they try and produce a return on the investments so that they can discharge the obligations when you come to retirement. And it's all a very, very complicated calculation, but that simplistically is what it is. But what has been happening in recent years with zero interest rates is that they realize that they're not getting the returns on their investments to discharge those long-term liabilities. And not only that, but there is another mismatch, and that is that the average bond portfolio probably has a maturity somewhere between 10 and 20 years, whereas every pension fund has liabilities going out over 60 years on current life expectancy. A 20-year-old coming in today is going to live till he's 80 on sort of approximate life expectations. So from his first contribution, there is a 60-year obligation on the pension fund. So what they have been doing is they've been trying to address the liabilities side of their balance sheet. And that is by using derivatives, interest rate swaps and so on, in order to try and protect that long-term position. What this has meant is that they have built up large derivative positions to try and control this risk. But rising interest rates have created calls on their derivative positions, which they have to meet. And they have to meet it immediately. So they're in the position where they're having to liquidate the bonds in their portfolios in order to meet these calls. Now, this is a crisis which the Bank of England had to step in to avoid. The lesson from this is that it's not just a problem for UK pension funds, it's a problem for pension funds everywhere in the world who use this, if you like, derivatives to try and manage their long-term liabilities. So what we are going to see is we're going to see the Fed, the ECB, the Bank of Japan, so on and so forth, dropping any idea of reducing their balance sheets, but going in and aggressively, quantitatively easing to try and stop this problem from getting any further. So there is going to be a new round of attempted interest rate suppression, which comes at a time when we're all seeing inflation running away at 10, 15, 20%. So this is the beginnings, I think, of the crisis, which I have been expecting for some time. This could rapidly disintegrate into a crisis which takes down the whole of the derivative market, threatens pension funds, creates an avalanche of selling, financial asset liquidation. I mean, your imagination can run riot on the bear side on this one. And I think that is going to be a problem which is going to be very hard for the authorities to control. And anything they do is going to be counterproductive. And it will be particularly reflected, I believe, in the currencies. So what we have, I mean, returning to our sort of core theme, as it were, as the implications of Kwarteng's budget, is that I think it has acted as a catalyst to bring on the financial crisis which we have been discussing for the last, 2, 3, 4, 5 years. So, folks, it's here, is my view.
If you're enjoying this interview with Alasdair Macleod and I, please consider subscribing to our YouTube channel and let the algos know you'd like to see more content like this. And if you'd like to learn more about systemic wealth protection, please do visit us at www.silverbullion.com.sg. Yeah, Alasdair, within all of that, I'm also hearing that gold is reaching new highs in British pound sterling. Is this true?
Yeah, it's not quite at new highs, but certainly it's doing its job. If as a UK resident, you have bought physical gold, yes, you've protected yourself against this situation. The same is true in the Eurozone for residents in Europe, and it's the same is true for residents in Japan. The same is true for residents in China. So gold is doing its job. I mean, the only reason that it has fallen quite significantly in dollar terms is because there is this general Keynesian flight out of what's perceived as risk currencies, risk assets, into short-term dollar liquidity. And under these circumstances, you just don't know when that's going to end. I mean, I've just sort of said that this crisis is probably just starting. In that case, it could well be that the dollar gets driven higher, in a very short period of time. It doesn't mean to say the dollar doesn't have problems. The dollar has exactly the same problems. It's just at the moment we recognize the risks more, if you like, in sterling, in the Eurozone, in the Japanese yen, in the Chinese yuan, than we do in the dollar. So what do? We get the hell out of those currencies and go into the dollar. Because in investment terms, what are you accounting in? You're accounting in dollars. That is how your performance is measured as an investment manager. That is therefore what you do. So, and we also saw, we saw exactly the same thing at the time of the Lehman crisis. We saw two things. We saw the flight into the dollar, obviously, and at the same time, we saw the price of gold fall, from under I think just about $1,000 down to I think 680. I mean, that was a very potential fall, but it set gold up for a subsequent rise up to 1920 by I think it was September 2011. So this I think I can see the same sort of dynamics working behind markets this time round. Only this time round, it is a lot more violent. So the idea that you can speculate by buying paper dollars, or even by buying paper gold, or even buying physical gold to speculate on the situation is crazy. You don't do that. What you do is you accumulate gold, which incidentally is legal money, and all the rest is credit, including the banknotes you might have in the back of your pocket. Okay? What you do is you move from credit into legal money, hold on to it, and you will eventually spend it. So this is the ultimate protection against these events, because at some stage, and we won't be able to predict when it is, the dollar will start collapsing in terms of its purchasing power at a phenomenal rate. And I think that the distortions that have built up in the whole system, and we're not just talking about the distortions that have been building up since the great financial crisis in 2008-9, we're talking about the distortions that have built up really from certainly the 1980s and possibly before, because it's the cumulative effect of state intervention to suppress markets. It's just gone on and on and on. Suppress or manage markets, however you like to put it. And the whole of the international establishment is angled to that suppression. That is now unraveling. This is a major, major event.
Yeah, I think as quickly as the dollar has shot up, I think it most likely probably could even come down a lot quicker than how fast it went up. But Alasdair, speaking of gold and of course money, Sergei Glaziev, this is a man who might knowingly or unknowingly might cause a spotlight to be shown on gold with the idea of a Eurasian trade dollar. Can you tell us a bit about this Eurasian trade dollar, what it is and what might it become?
Yeah, well, at the moment, it's a dream in Glaziev's eye, if you like, if I can put it that way. Really, the stated intention is to have a settlement currency between the Asian nations, which cuts out the dollar. The dollar, going via the dollar, if you're, let's say, doing a trade, let's say you're based in Mongolia and you're doing a trade with Kazakhstan, you've got to sell your currency, buy dollars, sell dollars, buy the Kazakhstan's currency. So, the dollar is always in there in the middle. And what's even more upsetting as far as the Russians are concerned is that all these transactions are reflected back in the US financial system. So this is intelligence, if you like, automatic intelligence that falls into the hands of the American authorities. So no, they don't want that. They want to get rid of the dollar. And so it's totally understandable from that point of view. But his problem is, what do we have to replace the dollar? So he's talking about a trade currency. And so far, he's announced that they're looking at the currency being comprised of a basket of the participating currencies and the commodities, a number of commodities in different areas, probably weighted in terms of the trade that goes between the various countries which are involved. Now, this is unnecessarily complicated. Not only that, but it defeats the objective of having it open to other members of the Shanghai Cooperation Organization and BRICS who might want to join in, because every time someone joins in, you've got to reset the whole thing, and it's complicated. And no, it's far better to have either something which is basically a basket of non-seasonal commodities and raw materials, or alternatively, their representation, which is gold. We all know that gold, in terms of its purchasing power, holds it over long periods of time. We know, for example, if you look at the price of oil, the price of oil today, compared with the price of oil in 1950, measured in gold terms, is down about 30%. Now, that's not volatile. I mean, since 1950 today, we're talking about 70 years. It's moved 30%. Compare that with what we've seen in the dollar. You can see that all the volatility is actually in the paper currencies, not in gold itself. So gold actually is where Glaziev must be going. Now, we don't know how far his thinking has evolved in this. And of course, there's an awful lot of politicking in any announcement that comes from someone like Glaziev. But as well as being heading up the committee looking at this on behalf of the Eurasian Economic Union, he has also put forward the idea that Moscow sets up its own Moscow gold standard. And the reasoning put forward is we've been kicked out of the LBMA, so we need to set up our own standard. And, that sounds perfectly logical and perfectly reasonable. But if you sort of put together the fact that the same man is planning a currency, a trade settlement currency for Asia, with this promotion of this new standard, you can see that actually there is a subscript here. And that is that far from just accumulating gold against the eventual possibility that Western currencies might fail and you've got to survive that, or indeed doing this so that you can somehow threaten the West. What we now have is a situation where the disintegration of the financial system in the West is now so rapid and so obvious and brought on to a large extent by Western sanctions against Russia. So, a lot of it is down to us. That I think that Russia and China are now looking at a situation where they need protection from the fallout of what we're doing. And I think that is the new situation. So I've always taken the view that if they suddenly announce that, we know, for example, that Russia has roughly 12,000 tons of gold in various accounts. I mean, there are two state accounts where these extra gold is held at around about 10,000 tons with about 2,000 on official reserves. Legislation has been passed in Russia to mobilize those reserves. Now, some people think that it's being mobilized so that they can go out and buy weapons or whatever. That's absolute rubbish. It's being mobilized so that it can be added to the official reserves. So we could find a situation where Russia turns around and says, we have official gold reserves of 12,000 tons. But that compares with a far larger country's reserves, America's, of 8,134 tons, of which there are some question marks over its existence. So I can see that this could be the equivalent of a financial nuclear bomb. So when I look at how the relationship between Russia and the West is progressing, and we're talking about saber rattling with nuclear weapons and all the rest of it, I think the real nuclear weapon is financial, and I think it's gold. So that's one which is very much a wild card, which could undermine things here a lot more rapidly than you would otherwise think reasonable.
Right, because with the intent of the Eurasian Economic Union to create a new trade dollar and, of course, Putin's Moscow International Precious Metals Exchange, do you think we will one day see a sort of an Asian Bretton Woods, a new currency system involving gold or some commodity, maybe, as you said, a commodity that's not seasonal, come to be?
Well, it's moving in that direction. Without any doubt, it is moving in that direction. Quite how they'll do it, I don't know. I suspect that the authorities in Asia will take the view that we as governments and as central banks have got the gold. We're not going to give it to our citizens. We're not going to offer our citizens a form of convertibility like the British gold coin standard that existed from 1817 to 1914. I have little doubt that that is going to be their approach. They're going to hope that merely by having the existence of substantial gold backing in their central banks or in their treasuries, that they won't need to deploy it. And so I think in that sense, I don't see a gold standard coming in, a proper gold standard coming in. However, that sort of situation, I think, is, it may not last terribly long. It will eventually be challenged. So I mean, depending on how the central banks use their newfound freedom to expand their currency in the knowledge, quote unquote, that it's not going to devalue the currency. That can only go so far. And I think without a proper gold standard, I see no discipline on central banks when it comes to printing currency, I should say, rather than money, to fund government deficits. So that is not going to be good enough. I think that might be an interim phase. But eventually, we're all going to have to go back to something more substantial than that. And the Rolls-Royce version of that, if you like, is really to have a gold coin exchange standard. So that if you have a banknote, you can submit that banknote and get paid or credited. Well, paid actually, not credited. I shouldn't use that term because we're trying to secure the value of credit. In physical coin. That has got to be the Rolls Royce, if you like, of gold standards. We will probably get to that in some distant future, but for the moment, I can see that the Americans in particular are going to be very reluctant to give up on dollar hegemony. What they would rather do is preserve the status quo, which basically means it will delay the dollar from introducing any form of gold backing. You've got to have a complete change, if you like, in economists' views, in the groupthink in the central banks, before we're going to get that far to stabilize our currencies in the West. So, but they will have to do it. I mean, the idea that currencies are just going to disappear and we're going to be left with nothing is, to my mind, nonsensical. What happens eventually is that these stupid Keynesian ideas and the group thinking in central banks, that gets ditched. And instead, what they do is they used, at this stage, the trillions and trillions and trillions of currency units as a means of distributing gold, if you like, in the economy. Now, they won't actually distribute gold in the economy, but what they will do is they will introduce a gold standard to make those trillions and trillions and trillions of currency units effectively gold substitutes. That is the way in which you get out of this awful, awful situation. They will be forced to do it. And of course, they need to do it credibly. It credibly could be, sort of 1 step, 2 steps, 3 steps. Failures, don't write, the failures to do this properly. Don't write that off. I mean, as I say, the Rolls-Royce standard is simple. It's got to be a gold coin exchange standard. Then you have got a stabilized credit system.
Okay, and so let's say perhaps for that to happen, either the BRICS countries, let's say they're going to have to introduce some type of a gold-backed system, or something catastrophic is going to have to happen in the West, where they will then make a move to some type of a gold standard once again.
Yeah, I mean, I think it's that is how things are really lining up. I mean, don't underestimate the dynamics which are going to collapse the currencies. The only way in which fiat currencies can survive is if central banks decide to sacrifice financial markets to preserve the currencies, rather than support the financial markets and risk undermining the currencies. It's a choice either or. There isn't really a halfway in this one, we saw this. I mean, we've seen this over time and time again. But the notorious one was really John Law, who was a proto-Keynesian. Don't forget, back in 1720 France, and his scheme, Mississippi scheme, started unraveling, and he basically tried to save it by printing an awful lot of money. What are we doing today with QE? We're doing exactly the same thing. So it's a process which will destroy the currency. And I can't see the system deciding to abandon financial values, because you abandon financial values, people start going bankrupt, they lose all their wealth, paper wealth all just goes down the toilet, and you get revolutions and God knows what. No, I mean, there's no way that the political class can condone, not just the political class, but also the central bankers in their group thinking mentality. There's no way they can condone a collapse of financial assets. And to the point about derivatives, which I was talking about earlier, the derivative position that the UK pension funds have got into, trying to manage their liabilities, you get a collapse in, in credit default swaps and all the rest of it. I mean, this could be a contagion which takes out roughly 700 trillion of over-the-counter derivatives. 700 trillion. Think of that number for a moment. That is actually what's at stake here. So this is why I think that while things have been sort of evolving really quite slowly since the great financial crisis, I think now it's speeding up hugely. And this is what we're seeing. I mean, we're seeing bond yields absolutely soar through the roof. I mean, I'm just looking at my chart here at the UK 10-year bond yield. I mean, back in end of July, the yield was 1.8%. It went up to 4.5% yesterday. I don't think any professional investment manager, pension fund, insurance fund, managing your portfolio, mutual funds, whatever, I don't think they've seen anything like this. But it's only just started, because why would you accept a yield of 4.5% on a UK gilt if inflation is going to rise from the current 10%? In other words, you're taking a negative yield of 5.5% now, and it's going to rise further, unless you really believe that the central banks are going to ensure that the inflation rate comes back to that 2%. Do we believe this? I think it's increasingly questioned. So you can see that we are on the edge of a very, very slippery slope in terms of financial asset valuations, because obviously, I mean, what's happening in the gilt market and US treasuries and so on and so forth has a major impact on the valuation for equities. And everybody's been sitting there asleep, just not understanding the violence, the financial violence that we're actually facing now. And we're going through this weird wake-up phase. And on top of that, we've got a financial war we're waging against Russia. Are we going to win that? Are we? Hell is like. I mean, this is not a good situation.
Alasdair, in the article you had written on Asian Bretton Woods, you wrote about China's gold policy and the articles or regulations. Could you go over some of the key articles, because these are a big key in understanding China's gold policy?
Yeah, well, I mean, there's bound to be a lot of confusion over this, because as things have changed, and I'm sure views in China have changed over time. And don't forget, on top of that, you've got a Chinese bureaucracy which is as bad as any other bureaucracy. And, bureaucracies basically don't have a sense of direction other than, job preservation, if you like, for the individual bureaucrats. But back in 1983, China passed legislation which appointed the People's Bank of China as sole agent for dealing in precious metals, gold, silver, platinum group metals. And at the same time, the population continued to be banned from owning gold and silver. So you can see that really what they were doing was they were preparing legislation which could be used, if you like, for the People's Bank of China to accumulate gold. Now, in terms of actual gold reserves, which are effectively included, if you like, in the People's Bank of China's balance sheet. I mean, it may not be directly on the balance sheet, but effectively marked as reserves. You didn't have much of this gold appearing. But just looking at subsequent actions, the indications are really quite clear. First of all, China invested huge amounts of money, capital, whatever, in gold mining. So much so that during that period from 1983 to 2002, when the Shanghai Gold Exchange kicked off, China became the largest gold miner in the world by huge quantities. I mean, it overtook declining South Africa, overtook America, overtook Russia, and so on. So it really did become enormous. And I think at the peak, it was mining something like 450 tons a year. Also, they retained very, very tight grip on refining. And we know that the Chinese imported large quantities of gold doré and silver doré for refining, and none of that went out. We also know that no gold was permitted to leave China at all. So the common thing in this is that they must have been accumulating gold as a matter of priority. Remember that in 1983, gold was in a bear market. So it was easy to acquire physical gold as it was being sold down by existing owners, as it was being sold into the market by miners and so on and so forth. Worldwide, there was quite a significant increase in the quantity of mined gold, increasing the amount of above ground stocks. A lot of that was absorbed by China. We don't know how much, but if you look at the foreign exchange operations of the People's Bank, at a time when, first of all, there were substantial currency inflows into China as predominantly American corporations were investing in manufacturing capacity. And then later, when you had export surpluses as a result of that manufacturing capacity, you had flows going the other way. If you take those flows and assume that, I mean, at the time, it was common wisdom, if you like, in Asia that you should have at least 10% of your assets in gold. Right. So they would have been, if you just take, say, 10% of those flows, a figure like 20,000 tons accumulated would make a lot of sense. We don't, as I say, we don't know the figure. But I assumed, therefore, on the basis of that that was the sort of number we might be talking about. Now, going back to 2002, so we're talking about an accumulation between 1983 and 2002. Following 2002, the Shanghai Gold Exchange had been set up by the People's Bank of China. And the Chinese citizens were then permitted to accumulate gold for themselves. And not only that, but you found that the state was advertising on television, go out and buy your gold. Now, most of this has gone into jewellery, but a very large slug of it hasn't gone into jewellery. And furthermore, some of the stuff which has not been delivered, shown as withdrawals from the Shanghai Gold Exchange vaulting system, has been retained within the vaulting system, but held on an investment basis, if you like, in the same way that Goldmoney for its clients has custodial gold in a number of vaults around the world. So, similarly, the stuff that hasn't been delivered, if you like, and therefore not recorded as publicly owned, which is actually publicly owned but within the vaulting system. The amount of gold that has been delivered so far, admittedly, gross of any scrap, has been over 20,000 tons. Furthermore, since then, the export of gold from China has been completely banned, other than small quantities through Hong Kong, which basically satisfied the cross-border trade, whereby people, to avoid sales taxes, walk into Hong Kong, go into a jewellery shop, buy jewellery, 24-carat jewellery in Hong Kong, and then go back into China. That has been condoned by the authorities by not taxing it. But equally, they have provided some limited quantities of gold back into the Hong Kong jewellery market for that purpose. But other than that, I mean, when I've spoken to directors of the Swiss refiners and said, have you seen any Chinese refined gold coming through? Any Chinese bars? Nothing. Absolutely nothing. Last time I asked a director before he retired, he said, "Well, I've heard that a few have been found, but we think that is smuggled out of China." So there's very, very tight control on gold. So this informs us of Chinese policy on gold. Now, originally, when this happened, there was a Marxist view that capitalism would lead to its own destruction. And so this would be manifested in the currencies. So you can see that Marxist economics could have driven the original 1983 legislation. The extent to which this is still the belief today, I think, is difficult to know. It is difficult to know what advice the leadership in China is actually getting on gold matters. They are continuing with their policy, but the idea that they still see gold as being the insurance policy is against a complete collapse in the West, it makes sense on one level, but on another level, they're doing exactly the same thing themselves with their currencies. And if you look at what the Chinese yuan has been doing recently, it's been collapsing against the dollar, just the same as sterling. The euro, the Japanese yen have been collapsing against the dollar. So I think there is less clarity, if you like, in Chinese gold policy than there is in Russia at the moment. Russia is a lot more focused because we have cut them off from the dollar, we have cut them off from the euro. The only reserves that they have actually are gold, and I think it's that is stimulating this Glaziev-led move into a new Russian gold standard and legislation releasing the gold held in state accounts to make it available as additional reserves for the Central Bank of Russia. So this is an interesting time, if you like, in that sense. But the underlying message is that if you want to get out of the fiat system, there's only one thing to do, and that is own physical gold and physical silver. That's the only thing you can do. And it's not a question of a diversified portfolio. It's black and white. We're not talking investments. We're talking money versus credit. If credit is collapsing, you don't want credit.
Alasdair Macleod, before we wrap up, can you let the good people know how they can follow you and stay abreast of all this information that you're passing out?
Yeah, sure. I write weekly for Goldmoney. It's published on Thursday afternoon, Eastern Standard Time, Thursday late morning maybe. And I do a market report on precious metals, which is released on the next day, the Friday, at around about the same time. And while you're there, you might look to open a Goldmoney account. It's easy to do. And it's a sensible thing to do in these circumstances, increasingly sensible.
All right. Couldn't agree more. Alasdair Macleod, we appreciate the time you've given, and I hope we can do this again soon, and it'll be interesting to see just what things have unfolded.
Yeah, it's very much my pleasure. Thanks for having me on.
That was Alasdair Macleod sharing his views on economics and precious metals. To see more of Alasdair's writings and opinions, please visit goldmoney.com. If you like this video, please consider subscribing to our YouTube channel, sharing our content, and giving us a thumbs up. These really do help us out quite a bit. Audio-only versions of this interview can be found on iTunes and Spotify.